We continue in our discussion of current liabilities by addressing the matter of what are called non-interest-bearing notes. There's no such thing as a loan that doesn't involve interest in some way, but some in this case don't have a stated or explicit interest rate. They're usually set up such that interest is deducted in advance through a process called discounting by the lender. The borrower receives only the net proceeds. Now, once again, we run into a situation. These may be recorded at the gross amount or the net amount because discounts are involved here, or a discount is involved. Let's look at an example. Bilco Inc. purchased a machine for an amount that we'll determine soon enough, paying $2,000 down and issuing a non-interest-bearing note with a face value of $8,000, payable in 9 months, and discounted at 6% for the difference. We want to record the purchase of the machine and the issuance of this note. The first thing we need to do is to determine the amount received for the note payable. And I put this in quotes because in this case we're not really borrowing cash, are we? We're buying a machine and we're giving up cash of $2,000, but we're also giving up this IOU, this note. But here we're not talking about receiving cash, but we are more or less receiving credit toward the purchase of this machine. The amount received equals the face amount of the note, $8,000, less the discount. And you can see how the discount is figured here, very much like interest, PRT. I've got these reversed for reasons I can't explain, but there it is. $8,000, the principal, that is the basis for calculating this discount, times 6%, the discount rate, times 9/12, the period involved. And so you can see that gives us $360 of discount. And think of discount as future interest expense. So we deduct that $360 from the $8,000 face amount of the note to get $7,640. So that's the amount, more or less, of credit that the lender, or in this case the vendor, is giving us toward the purchase of this machine. Well, here's the entry we would make under the gross method. Under the gross method, we're going to record the face amount of the note payable in the note payable account, and we're going to set up a discount on note payable account for the difference. So notice here we've got a credit to note payable of $8,000, a debit to discounts on notes payable for $360, credit to cash for the $2,000 that we're paying, and that debit to machinery or equipment, however you might want to do that, $9,640 is a plug figure. It's the result of these other items here, which is kind of interesting. Notice here the recorded cost of the machinery is the present value of what's given up in order to obtain it. This assumes that this present value is at least as readily determinable as the value of the machine itself. If you recall from Chapter 10, we will record a long-term asset at either the value of that asset or the value of what's given up to obtain it, whichever is more readily determinable. And if in fact it's a toss-up between those two, then we will we will use the value of what's given up in order to obtain it as the basis of recording the value of that asset in our records. So here, debit machinery $9,640, which represents the fair value of the cash and the note that we are surrendering or giving up in order to obtain this piece of machinery. We also want to record the payment at maturity, and you can see here we've got to debit the note payable for $8,000. We've got to get rid of that discount on note payable for $360. And notice what happens, that discount here, when we recorded it, I said it's future interest expense. Well, here's where we recognize that interest expense of $360. Of course, there's the cash of $8,000 that we have to pay in order to pay off this note. Now let's record this same purchase and retirement or payment of the note under the net method. First of all, the purchase of the machinery and issuance of the note. Under the net method, we're not dealing with a discount account. We're simply going to record that note payable at the net amount. That is the gross amount less the discount. And so you can see here we're crediting cash for $2,000 as before, crediting notes payable for its fair value, its present value after the discount of $7,640, and again debiting machinery for $9,640. So you can see that the recorded cost of the machinery is the present value of what's given up for it. And so whether you use the gross method or the net method, that recorded value of the machinery does not change. In the second part, or part B here, when we record the payment at maturity, you see that we are debiting that note payable for the $7,640, which eliminates it from our books, or eliminates the balance in that account, crediting cash for $8,000, and there's that interest expense of $360. And so once again, we see that the note payable is eliminated, just like it was under the gross method. We're paying cash of $8,000, and the interest expense and of course the recorded value of the machinery are the same under the two methods. Now let's complicate it with just a little bit of a twist here and say, well, let's consider how we would accrue the interest at year end if this note in fact straddles two reporting periods. For example, let's say the purchase and the note issuance at that time occurs on October 15 of 2018 and the note matures on June 15 of 2019. Assuming Bilco's year end is December 31st, what accrual is required under each approach? Well, think about what we did under the interest-bearing note before. We have a debit to interest expense, okay, and typically a credit to interest payable, except in this case, we've actually already, in one sense, recorded or anticipated that interest expense through the discount account. So, here's the entry under the gross method. Debit interest expense, $100, credit the discount on note payable of $100, and you can see how there may be a couple of ways to come at this one, but in fact this is more or less what we might call a straight line method, where we simply say, well, the total interest is $360, and that's the interest for 9 months, and so that's $40 per month, and since October 15 to December 31st, that's 2.5 months. There's our interest for the period ended December 31st for this note. In other words, the interest from October 15 of 2018 to December 31st of 2018 is $100. So notice now we're crediting or reducing that discount on note payable account. Now, what would be the revised payment entry at June 15? Well, we've got the debit to notes payable. Under the gross method now, we have recorded that $8,000 in the note payable account. So again, we've got to eliminate that. We've got a credit to cash of $8,000 as before. And notice here that we have recorded that discount. Now we've already reduced the discount by $100 as of December 31st through that adjusting entry. Well, here's the rest of it. We had this future interest expense and the discount on notes payable account. It was a debit balance. Now we credit discount on notes payable and eliminate that balance, and we record that as interest expense. So note that after the adjusting entry at 12/31, the discount on notes payable balance was $260, and therefore the discount on notes payable balance to be eliminated upon payment is $260. Now let's look and see what we would need to do under the net method. Under the net method, recall that we don't have a discount account. And so we would figure the interest the same way as we did before, straight line method, $100. But notice here, we debit interest expense and we credit note payable. Notice we don't credit interest payable here because, in fact, this was a discounted note. So we credit note payable. And notice what that's going to do, of course, is increase the balance on that note payable. And then when we make the final payment here, or we pay off this note on June 15, notice we debit note payable for $7,740. That's the original issue price of $7,640, plus the $100 adjusting entry or adjustment to that we made at December 31st. So we eliminate that note payable balance. We credit cash for the $8,000 that we're paying, and we debit interest expense for the interest basically that is attributable to that period, January 1st of 2018 to June 15, 2019. Notice that the adjusting entry at 12/31 increased the note payable balance to $7,740, and so that balance is eliminated upon repayment. And once again, you'll want to note here that the interest expense under the two methods, gross and net, is the same, that the note payable is eliminated under both cases. The amount of cash paid out is the same. The recorded value of the equipment is the same. So these are just two different ways of achieving the same result. One final question, and that is, what's the effective interest rate on this note? And you might grab at that 6% and say, well, at 6%, that's the discount amount. But there's something interesting going on here that we need to recognize. First of all, let's note that the interest, that 6% of the discount amount for the 9 months was $360. And therefore, the price that we more or less received for it, the issue price, was $7,640. And of course, the time frame for calculating that discount was 9/12 of a year. And we can calculate the interest here. This is what's kind of interesting. The interest of $360. Now, that's 6%, of course, was imposed on the full $8,000. Not the amount that the company received. That's not the way that we normally calculate interest. The company didn't receive $8,000, nor did it get credit for $8,000. You got credit only for $7,640. So if we kind of back into the interest rate here, we see that the company paid interest of $360. It received, and I'm kind of doing with my fingers the quote signs here, $7,640, and of course that interest was calculated for 9 months, 9/12 of a year. Then actually the rate of interest on that loan was 6.3%. So it's something for us to recognize here, and we'll have more to say about that in class. I'll stop here and set up a new video for this, or save some of this for class.